Our session is on risk and return. In this session, we cover important concepts that we need to understand before returning to more practical applications of finance. We cover 5 topics: capital market history of risk and return, market risk and return, measuring and reducing risk, Markowitz portfolio theory, and the important concept of the capital asset pricing model. This graph shows the value of $1 invested in 1900 in nominal terms, that is not adjusted for inflation, that would be achieved by the year 2004 for 3 separate alternative investments. The first investment alternative is shown here in this green drab line, and that is Treasury bills. If an investor had put his or her money, $1 of his or her money, in Treasury bills in 1900, by the year 2004, the investor would have $61. The second alternative is U.S. government bonds. If an investor had put $1 in U.S. government bonds in the year 1900, by the year 2004, that investor would have $147. And finally, the red line indicates the common stock market in the United States. If an investor put $1 in a highly diversified portfolio of common stocks in 1900, by the year 2004, the investor would have $15,578. As you can see, these 3 investments yield very different rates of return. Investing in the stock market yields a very high rate of return, while investing in Treasury bills yields a very low rate of return. So why would anyone put money in Treasury bills when that person could put money in the stock market instead? The answer is that investing in Treasury bills is considered to be very low risk. In fact, Treasury bill investments are considered to be risk-free. And you can see that over the period 1900 to 2004, there was really very little, if any, reduction in the value of the investment one year to the next. In contrast, look at the red line representing the returns for common stocks. As you can see, the value of a stock investment, while generally going up, oftentimes takes a dip. So you can see this dip here was actually the stock market crash that began in 1929 and lasted through the 30s. We can see another dip over here, which was the stock market crash that occurred in 1987. And then finally, the dip that occurs right toward the end of the time period we're looking at is the stock market crash that occurred roughly starting in 1999. These occasional dips in the value of stocks or a stock portfolio represent risk to the investor. So you can see that an investor has an essential choice between a high-risk, high-reward type of investment and a low-risk, low-reward type of investment. Returns on these types of investments are often represented by the risk-free rate, which is typically associated with the rate of return on Treasury bills, the market rate, or the rate of return on the stock market, and the difference between these 2 rates, which is called the market risk premium. The market risk premium represents the reward to the investor for being willing to put his money or her money in the stock market as opposed to in treasury bills. It's a premium or a higher rate of return that the investor earns for being willing to take on higher risk. This slide shows the average market risk premia for developed countries. As you can see, the premia run from a premium of 4.3% for Denmark up to a premium of 10.7% for Italy. The risk premium for the United States stock market is somewhere in the middle. Investments in the U.S. stock market have paid on average 7.6% higher than investments in U.S. Treasury bills over a long period of time. This graph shows the distribution of annual rates of return in the U.S. stock market over more than 100 years. As you can see, it's most common to earn somewhere between 0 and maybe up to 30 or 40% one year to the next on an investment in the U.S. stock market. However, if you draw a line right about here on the graph and add up these numbers, you can see that over 28 years in the past 100 plus years, investments in the stock market would lose money. Indeed, in 2 years, stock market investments lost more than 30% of their value. These years in here would be considered stock market crashes. At the other end of the distribution are years where an investment in the stock market paid over 40%. But the most common returns are given in this part of the graph. And the important point here is that there's kind of a central tendency for a positive return on the stock market that's pretty good, but a wide variation in returns one year to the next. If we combine this graph with the first one we looked at in this session that showed the future value of a dollar invested in 1900, we see a couple of important lessons. The first is that leaving your money in the stock market over a long period of time will give you a very good rate of return. However, if you only have a short period of time to invest your money, you take a significant risk if you put your money into the stock market. Risk in financial investments is typically measured by standard deviation. To get to standard deviation, we start with variance, which is a statistical concept indicating the average value of squared deviations from a mean, or expected value. And then standard deviation is the square root of that average value. Standard deviation is a common financial measure of volatility or risk. Financial risk can be reduced through diversification, which is a strategy designed to reduce risk by spreading the portfolio across many investments. To see how diversification can reduce risk, we need to distinguish two types of risk. The first is unique risk, which reflects factors associated with specific firms. Unique risk can be eliminated by diversification, and therefore it is called diversifiable risk. A second type of risk is market risk. Market risk reflects economy-wide sources of risk that affect the overall stock market. It's also called systematic risk, and it can not be eliminated by diversification. This graph shows the general relationship between portfolio risk, as measured by standard deviation of returns on the portfolio, and the number of securities in the portfolio. The principal relationship is that as the number of securities in the portfolio increases, going this way, the overall portfolio risk diminishes. The graph also shows how market risk plus unique risk yields overall portfolio risk. Or looking at it another way, total portfolio risk is the sum of unique risk and market risk. By increasing the number of securities in the portfolio, unique risk can be reduced, so that the overall portfolio risk also can be reduced. But there is a limit to the extent to which diversification can reduce portfolio risk, and that is given by market risk. So as the graph shows, unique risk can be reduced or eliminated by effective diversification, whereas market risk is always there. Most investments involve taking on risk with the expectation of a return. That is to say, people typically have twin investment goals. They want to increase their expected return, and they want to reduce their risk. According to portfolio theory, combinations of stocks or portfolios can reduce risk because of the negative correlation of returns across various stocks in the portfolio. Efficient portfolios are defined as weighted combinations of stocks that maximize return for a given risk level. Let's look at the combinations of risk and return offered by some hypothetical individual stocks. Here is the distribution of returns for investment A. As you can see, investment A has an expected return of about 5%, but a wide distribution of potential returns. So investment A would be characterized by a high standard deviation or a high degree of risk. Here's a very different investment. Investment B has the same expected return as investment A, about 5%, but the width of the distribution for investment B is much narrower. So investment B is characterized by a lower standard deviation or lower risk for the same expected return as investment A. Investment C offers a higher expected return than investments A and B, around maybe 20 to 25%. And the range of results for investment C is kind of in between what we saw for investments A and B. Investment D has about the same width of potential returns as investment C, but a lower expected return than investment C. On this graph, we've plotted the risk and return for investments B and C. We've eliminated investments A and D because they're inferior to B and C in the following way. Investment B has the same return and lower risk compared to investment A. And investment C has the same risk and a higher return compared to investment D. So we can eliminate A and D as potential investments in our portfolio because they're dominated by B and C respectively. But we can't eliminate investments B and C because neither dominates the other. Investment B is characterized by low risk and low return, and investment C is characterized by high risk and high return. Some investors who do not like risk might prefer investment B, and other investors with a higher risk tolerance might prefer investment C. The good news is that most investors don't have to choose between putting all of their money in B and all of their money in C. Rather, they can choose a combination of investing in B and investing in C that typically will give them a better result than putting all of their money in one or the other. And that's the essence of portfolio theory. Because of the negative correlation of returns for investments B and C, we can generally get a better result by some combination of B and C than we can get by putting all of our money in B or in C. Specifically, we can get a higher return for a given level of risk by some combination of B and C, or we can get the same return for a lower level of risk. That is, we can, by combining B and C in various ways, we can move along this red line of potential risk and return results rather than choosing between these two endpoints. Now let's add another stock, let's say investment N, which has a lower risk than C and a higher return than B. If we add N to our portfolio, we push our envelope of potential returns farther toward the northwest part of this diagram. And our goal in portfolio design is to move up and to the left, that is, toward higher return and lower risk. As we continue to add stocks to our portfolio, we'll move up toward this line, which is called the efficient frontier, because it maps out the efficient combinations of risk and return that are available to the investor. The efficient frontier travels from portfolios that are characterized by low risk and low return through those that are characterized by low risk and high return to those that are characterized by high risk and high return. So the efficient frontier includes some really low risk, low return portfolios, some really high risk, high return portfolios, and then portfolios that are in this ideal quadrant, which is low risk, high return. The stock portfolios that are available to the investor lie below the efficient frontier. So an investor could pick a stock portfolio. The efficient frontier indicates the combinations of return and risk that are available to the investor that invests only in the stock market. But investors can also choose to put money into treasury bills and earn a risk-free return. The opportunity to combine investments in risk-free instruments such as treasury bills with investments in the stock market maps out the efficient, or identifies the efficient portfolio, which is indicated by this point, a line tangent between the risk-free rate and the efficient frontier. So now we have an expanded set of opportunities available to the investor. The investor can select any point along this line connecting the risk-free rate to the efficient portfolio, and even going up here. So the investor can choose a combination of the risk-free rate and the market rate of return by choosing any point along this line. The line connecting the risk-free rate to the rate of return and risk associated with the efficient portfolio is called the security market line, and it's given by the risk-free rate plus beta times the market risk premium. Recall, the market risk premium is the difference between the rate of return earned by an investment in a diversified portfolio stock and the return that is paid by Treasury bills, or the risk-free rate. The slope of the security market line is beta. Beta is also on this axis, indicating the degree of relative risk. So the investor is allowed to choose a combination of risk and return that's indicated by any point along this line. Moving up and to the right on this line increases risk and return, and moving down to the left on this line reduces risk and return. If the investor is comfortable with a risk indicated by a beta of 1, the investor is going to put all of his or her money in the stock market and earn the return on the stock market. If the investor is uncomfortable with that level of risk, the investor will put some money into risk-free investments and some in the stock market, and select a combination of risk and return somewhere in this area. And finally, if the investor is comfortable with a risk level that is indicated by a beta of more than 1, the investor will actually borrow at the risk-free rate and invest more than his stock of wealth in the stock market, and thereby take on more risk in the hope of higher return. The security market line describes the capital asset pricing model, which we will develop more fully in the next section. The capital asset pricing model states that the required rate of return on an investment, or the discount rate, or R, depends on the risk of that investment compared to the risk of investing in a diversified portfolio of stocks.